So welcome to our presentation tonight at Campus IECFB for our brokers. And tonight we're going to talk about something a little bit different. We're going to talk about something that we get questions on all the time, and that's about the comparison and differences between MCA advances and factoring. So we're going to dive into that a little bit tonight. Now, in training in the campus, when you go to the campus, we do provide, obviously, we do a lot of training for factoring and so on and asset-based lending, but we do also give you training for merchant cash advances and ACH advances. So we do give you training in this, although most of our brokers don't do too much work in that area. We do touch on that, and we do give you some training. But today, I think we're going to go over to the magazine because we have several articles. We just put an article up as a matter of fact. So let's go over to IECFB magazine over here. And yeah, right here, we've got one that was just put up for this month's Editor's Choice. Cash advances, invoice factoring versus MCA advances, you be the judge. So we're going to talk about this, as a matter of fact, right now. So let's go ahead and take a look at this article. Okay, so invoice factoring versus MCA advances, and you be the judge. So one of the most common questions asked by new factoring brokers and consultants, which when first launching their financing consulting businesses in our industry, the question is, what is better, factoring or merchant cash advance? What's the best way to solve the cash flow problems of a non-bankable business owner in need of quick cash? This is a common question asked by your business owner or prospect, and it's important that you, the trusted financial consultant, know all the answers. So let's take a look at a side-by-side contrast and comparison of these two popular financing solutions. And then you can be the judge as to which is the most advantageous for a particular client. So one of the real questions is, they get compared all the time, but are these financings actually apples to apples? When you first begin to compare factoring versus merchant cash advances, and we will include ACH advances as well, the most important concept that you need to understand is, what kind of financing is this? Both of these financings are considered to be off-balance sheet financing because neither are considered to be loans. They are not new money for the business, such as an asset-based business loan or standard SBA loan. They are an advance. Okay. Factoring, however, is a little bit different. Factoring is the purchase of the current invoices of a business, and as such, it's only available to those businesses that actually invoice, businesses that operate B2B. The factor's advance is a purchase of the business accounts receivable. It converts an account receivable to immediate cash. An MCA and ACH is an advance on future and anticipated sales revenue, and usually from credit cards or over-the-counter cash sales. Although it can also represent invoice sales as well, MCAs and ACH providers are not a buyer of the sales because they do not actually exist yet. It only advances on anticipated sales based on anticipated historical data. So while both compare as a source of business financing and funding, the contrast of the two is significant. A factor advances as a purchase mechanism on existing sales that are invoiced and recorded. These are sales that already exist, and they have generated an identifiable income for the business that can be counted on. MCA and ACH financing represents cash that is projected as a best guess of future credit card sales or over-the-counter sales. Another way to compare these two financings is that factoring is a method that a business owner uses to finance It's loan business. We wonder about, what are we talking about loan business? Well, factoring is used to finance the business's terms of payment. All businesses that are B2B are lenders. They don't even realize it at first, but they actually are. When a business offers 30 and 45 and even 60 days for a customer to pay an invoice, that business is actually providing a short-term loan to its customers. Such invoice loans to customers are part of the working capital of the business. Factoring is used literally to accommodate those invoice loans to customers. And as an additional benefit, such liberal payment terms usually lead to more customers and larger orders. Lenders offering MCAs and ACH financings have nothing to purchase or loan against. It's often called crystal ball financing, which is offered to typical non-bankable business owners in need of emergency capital for some business equipment or for a location upgrade or similar. MCAs and ACH advances are seldom used for financing B2B business owners and so on, and are very typically used to finance consumer service businesses such as restaurants or convenience stores. Clients risking of payment in the advance area are dramatically different. All advances, whether through factoring or through merchant cash or ACH advances, must be repaid, obviously. Here, factoring simply wins hands down as an option because since the only risk a business owner shoulders regarding repayment of the advance to the factor is the risk that an invoice is declined for payment by a customer because of a trade dispute, they're fighting over some kind of a product, or if a customer actually goes bankrupt while the invoice is being financed. But these situations are rare, and factors additionally review the credit of every customer of a business prior to financing. That's another benefit of factoring. So the repayment for the factor's advance as part of the purchase of the invoice is almost assured. In contrast, an MCA or ACH advance financing is always at risk due to a decline in future sales. For example, what if your client's business suddenly faces a competitor that cuts their pricing and forces your client to do the same? Future sales are at risk. Profits are also at risk and not assured. Additionally, the ability of the repayment of the crystal ball advance to the financing company is anything but assured. Evidencing additional risk, the MCA provider typically automatically draws its portion of daily sales cash, known as retrieval rate, out of the business's bank account. If the sales are down and the cash is not available, serious penalties for the business owner can apply. In some instances, a business that is in default, the MCA lenders require refinancing or stacking advances, forcing an owner to pay an additional payment on a new advance, and which can often become completely impossible to manage. So when it comes down to financing your clients, factoring versus merchant cash in advance, what do you do? How do you recommend factoring to one of your clients? And when do you recommend an MCA and ACH to an advance, one of your clients as an advance? As a valued broker or consultant to your client, your knowledge in this area is important since the business owner will be, to some extent, depending on you. And the general rule is if the client business operates business to business or B2B, generates invoiced sales, and traditional bank financing is not an option, you will always, always, always recommend factoring, or at least rule it out as a ready option first thing. The good news is that the vast majority of B2B businesses qualify easily for any factoring arrangement, so long as their invoices are not pledged to some other pre-existing loan to some other lender. Factoring is also relatively inexpensive when compared to MCAs and ACH advances, and also provides many additional benefits to the business owner. Merchant cash advance business loans should be typically viewed as loans of last resort for retail businesses and those that operate B2C rather than B2B. These types of cash advance can be viewed as similar to very short-term loans and usually for business emergencies or for equipment purchase, but only when equipment leasing is ruled out. There is a place and time for MCAs and MCH advances that can be used very successfully and especially in retail. But as valued brokers and consultants, before you opt for these crystal ball loans, make certain you have eliminated all other asset-based options first. So that gives you some basics for the difference between MCAs and factoring. We have additional articles on our magazine on MCAs and factoring and the comparisons between the two. And by all means, take some time out to go to our magazine or to the academy at iacfb.academy to find out more about factoring and its relationship to financing small businesses. I'll go ahead and put some links in the information below. And as always, go ahead and subscribe to our channel. It's a channel for brokers, factoring brokers, and consultants. And for that, I think I'm going to let you guys go and have a great weekend. Bye-bye.